Good day, everyone. I'm Michael Chang, Chief Investment Officer Fixed Income at RHB Asset Management. Thank you for listening again to this update, and it is my sixth podcast series. On this update, I will be giving a regional view arising from the implications of the COVID-19 pandemic. As at September, 61% of countries in Asia-Pacific region have yet to open their borders to travelers, making it the most closed-off regions for tourists in the world, together with the Middle East of 62%. According to the World Tourism Organization, 19 countries in Asia out of 27 in the world have been closed off for 30 weeks or longer. Most countries that eased restrictions were advanced economies. Therefore, the tourism sector in Asia will still be affected as border restrictions remain high. The Asian Development Bank (ADB) projects that many developing nations in the East Asia or Pacific region will take a major hit economically due to the coronavirus outbreak, but some are also expected to finish off 2020 escaping negative GDP growth. Vietnam and China are expected to grow GDP of 1.8% each for the year. Taiwan is projected to escape the negative figures narrowly at 0.8% growth. On the other hand, countries that rely on tourism heavily, such as Thailand, has proven more vulnerable in this crisis, as are countries with high household debt, such as Thailand and Malaysia as well. Finally, countries with prolonged lockdowns and high cases, for instance Indonesia and Philippines, are also suffering the economic consequences. That said, demographics of a country also play a role in terms of COVID-19 impact. For one, Indonesia is less sensitive to external demand and supply chain shocks, as it has a huge consumer market. Net exports account for only 1% to 2% of real GDP. Indonesia is not a big part of the global supply chain, which means less disruption for its manufacturers. Point to also note is Indonesia has a relatively younger population versus its total population, which suggests demographically they should have a stronger resistance against COVID-19 compared to a country that has a higher proportion of older population. Comparably, Thailand's economy appears the most vulnerable despite the lockdown being less severe. The Monetary Authority has less conventional policy space to support domestic demand. Many Thai households and businesses are highly leveraged. Thailand also has a larger sensitivity to tourism, which accounts for close to 20% of GDP. Currency strength also puts Thailand exports of goods and services at a competitive disadvantage. Thai baht has gained 21% against trading partners in the last 6 years. Therefore, the pace of recovery for COVID-19 will vary nation to nation within Asia Pacific, as it will be a combination of many factors, i.e., not just stimulus, but economic progress, demographics, financial conditions, how open the economy is, and efforts to COVID-19 containment. The COVID-19 situation regionally, although worrying, is still one of the lowest when compared to the USA, Eurozone, and Latin America. ASEAN's rate of transmission is 582 per a million people versus Europe's of 4,121, which is 7 times the severity compared to ASEAN, and we are not even comparing to the USA or Latin America. In terms of mortality, ASEAN is still the lowest at 16 per million people versus the rest of the world. Asian central banks have reduced interest rates in a coordinated manner as with other central banks globally. Common goals would be credit intermediation in their countries and liquidity. For example, in Indonesia, Bank Indonesia, and in Thailand, Bank of Thailand, have initiated bond purchase programs. Such coordinated moves were unheard of in the previous financial crisis. For Indonesia, the bond purchase programs were also to stem the rupiah weakness. Besides monetary policies being accommodative, governments within Asia are determined to revive their respective economies by dishing out record stimulus as a percentage of GDP in the form of fiscal and financial support, though financial support forms the majority of most stimulus. Lastly, the focal point of most discussions among the market participants would be the US presidential election slated for Tuesday, November 3rd, 2020. A victory by US President candidate Joe Biden in next month's election could push up Treasury yields, according to some analysts. A major reason behind the heightened sensitivity of South Korean and Thai bonds is the nation's relatively higher dependence on trade, open capital accounts, and narrow yield spreads over treasuries. A Democratic clean sweep of the presidency and both houses of Congress may jolt the US Treasury's 10-year yields higher 30 to 40 basis points over the following month. That is to reflect the possibility of substantial higher federal spending with Biden. At the other end of the spectrum, China's debt has been the least sensitive, with a ratio of just 0.02. The lack of responsiveness appears due to the nation's relatively low dependence on trade as a percentage of its GDP and the subdued level of foreign ownership of its bonds. This dynamic could, however, change moving forward due to the rising overseas participation in the country's debt market and its recent inclusion in the FTSE Russell World Government Bond Index. In view of the impending volatility arising from the US presidential elections, any adverse spike in yields, especially in Malaysia government securities market, presents an opportunity to accumulate, as the general interest rate trend for Malaysia will remain low for a considerable period of time. We hope this podcast has been useful to you, and thank you for listening.